Okay, Zach Bassett again with COS Accounting and Tax, doing my compounding interest videos in conjunction with the podcast. Today we're going to talk about tax planning, one of the most important parts of having a career, whether you're on W-2, 1099, you have your own business, whatever it might be, you've got a tax plan. If you're not doing tax planning, you're costing yourself, I'd say, at least $1,000 on average. Many of you will cost yourself $10, $20, $30, $40,000. Can't tell you how many times I've had people come to me after using their dad, who's a CPA, for X amount of years. They do door to door. Their dad wants to continue to do their taxes, and then they come to me and I save them $30,000 in taxes. We'll have some testimonial videos where you can hear from people where that actually happened. So make sure you keep an eye out for that. But it's just super, super important. So please tax plan. Whether it's with me or with someone else, it's that important. To me, it's almost as important as your career. If you watch the Rule of 72 video, you're going to see just how important saving a few $100s or a few $1,000s can be. So watch that video. It's awesome. So tax planning, we do this in the fall. If you're a client of ours and you're on a 1099, which most of you are, we're going to ask you in September, we're going to ask you how much money did you make. So let's say you tell us you made $100,000. We're then going to do a wage for you on your quarterly reporting, because as you know, all S corporations have to have a minimum of one employee. That employee has to pay themselves a wage. So that's how you get out of paying so much in the self-employment tax. So first thing, that's what we're going to do. Start off with the 100,000 number. And we're going to figure self-employment tax right off. If you're door-to-door, because I know those numbers really well. We don't have to get to profit first. Now, in this case, I would do a wage of $18,000. So that's to be safe. We're going a little bit high. We're doing 18%. I know that we can go as low as 16% and still not get an audit. But to be safe, we do 18%, make sure that we don't get an audit. I've done over 15,000 S-Corp returns, never had a single audit, not one. So that has a lot to do with it. Knowing the differences of where we can be aggressive, where we can't. That's kind of where I feel I set myself apart from other tax accountants, especially if you do direct sales. I'm gonna get you a really good tax outcome, and I'm not going to get you an audit. If you did get an audit, of course I would be there to help you through it. But like I said, zero in 15,000 plus returns that I've done over the years. So, and that's S Corp returns. So we start out with that, we get the wage. Now we're gonna have to figure self-employment tax. So I'll pull up my calculator real quick. We've got 18,000 times 0.153. So you got 2,754 in self-employment tax. So we've already got that number out of the way. And for those of you wondering, well, how much would it have been if I was on a W-2 or if I was on a, if I didn't have the S corporation? Well, in this case, you'd be paying self-employment tax on the 100,000. So you'd have 15, well, actually on the profit. So I'll tell you what it would have been once we get to profit, but it's going to be a whole lot higher than 2,754. We're also going to have federal and state taxes. We'll get to that in a bit. But first thing we're going to do, second thing we're going to do for the tax planning is we're going to start going over your expenses. So I'm going to ask you, how much did you have in rent? Let's say you had $5,000 in rent during the summer. You can't take rent on your, own personal home. You can take the corporate rent expense, but that's different. It's not like what your actual rent is. So only time we take rent for where you're living is going to be when you're out of state working. So a lot of you door-to-door guys that go out of state and have to get a place, we're going to take that amount. So some of you guys probably think, well, my company reimburses me for it. so I'm not going to take it as an expense. Well, I work with a lot of the companies that you work with, and many of them, the way they do it is they reimburse you for the rent, and that amount is then included in your income up here. So that means we've got to take that out. If we don't take it out, well, then you're paying tax on more money than you should. So you can trust me on that. You can ask your company about it. They'll let you know. A lot of them will have a hard time knowing or explaining, but every company that I've worked with that reimburses rent includes that number here. So you'd want to take it off. So we've got rent. Next we might take flights. So let's say you've got 3,000 in flights, and then you've got hotels. Now, you can't just take every time you take a flight or, stay in a hotel, but you can be pretty aggressive on these. If you do some work-related stuff, I would take the expense, because that's one of the things you'll hear me talk about is being aggressive. I am okay with being aggressive when you actually had an expense. So if you had an expense for flights that were $3,000, but maybe 500 of them were a little bit work and play, well, I'm going to say let's be aggressive and take that. Whereas if you want to take 5,000 but you only had 3,000 in flights, I'm going to say, sorry, we can't do that. I'm not making up expenses on your return. Saving my clients money isn't worth losing my ability to save people money. So let's say you have 2,000 in hotels. I'm going to make the numbers so that we can do the math pretty easy. A big one is going to be mileage. So you get 58 cents per mile. So it's super important that you're tracking those miles. I would use the app. It's going to be called QuickBooks Self-Employed. Don't get the non-self-employed version. You'll be paying too much and you will have to do a lot more. This one is awesome. It's just going to make your life easy. You're going to track expenses. You're going to track all expenses with it by getting your phone out anytime you have a receipt, and you're just going to take a picture of it and then log it into the area. It's going to learn where to go. So next time you go out to eat at Chick-fil-A, it's going to know where that goes. So you don't have to continuously find where to put it just the first time. And then it's also going to automatically track your miles, which is awesome. I know there's Mile IQ and TaxBot, a few other things out there that are going to help you, but this one does it all, and it's $5 or $10 a month. So get it. You also get to deduct that $5 or $10 a month. So you're getting a 20 or 30% discount whenever you buy something for the business. So keep that in mind. But yeah, it'll auto track. So anytime you drive, it's just going to automatically track it, which is super cool. You do have to log in and say whether it was business or personal. But if you're out during the summer, just take it all as business, because you're literally out of state working. So everything is for work. So track all those miles. We're going to have other things like so miles, better put that in. Let's say you had the equivalent of $10,000 worth of miles at 58 cents a mile. Not going to do that math right now. But yeah, we're going to have recruiting. If you're a door-to-door guy, recruiting should be a big part of what you do. I can tell you, I've done taxes for, thousands and thousands of these guys. And the guys that recruit make a lot more money than the guys that just knock. So super important to me is if you're in the career of door-to-door sales, make it what it can be worth. Do everything possible to make that money and just do things to the fullest. So recruiting is big. Let's say in this case it was 10,000. And normally it's the managers that are doing a lot more recruiting. But this will also include, sometimes separate, it could be incentives. So if you buy your guys, I'll make it separate. But if you buy your team things throughout the summer, like let's say you have a competition where, hey, if you sell this many by noon, you get this, or a lot of the different cool things that you guys do, you're going to want to track those incentives, because yeah, you're going to get to write it off. If you don't track it, you don't get to write it off. You don't get the tax break. So make sure you're tracking every last one of those things you do for your team, whether it's a pizza party or you buy them a new Segway for hitting X amount of sales. So between recruiting and incentives, let's say that's 5,000. And then you've got, let's see, what are some other things we would take? Uniform. Anything you buy for knocking, so shoes, shorts, pants, gloves, hats, all that stuff, you want to make sure to get that in there. Equipment, new iPads, phones, computers, Segways. If you buy a drone to make video to recruit with, then you want to get all that stuff in equipment. I mean, this is just further showing how important it is to be on a 1099. If you're on a W-2, you wouldn't be getting any of these deductions. So in this case, let's say it's 5,000 for uniform and equipment. And then for those of you that don't drive during the summer, a lot of you guys don't drive, so make sure that you're tracking gas pitched in to your friends, whoever's driving for the day. You're gonna, if you give them $5, $10 a week, track that amount because you can expense that off. Now, that does bring me to the point of how important it is to have miles. Sometimes people ask me, is it worth bringing a car out or not? In my opinion, it's definitely worth it, as long as your vehicle is not, a gas guzzling, expensive vehicle. You want your door-to-door car to be something like a Honda Accord, 2000 Honda Accord. Great gas mileage and runs forever. If you've got a brand new Audi that costs $75,000, you don't want to be putting miles on that. Use the Audi for recruiting outside of the summer. So let's, I'm sure there's more expenses we could come up with, office expenses is one, supplies, but we'll stick with these. And it looks like we've got 10, 20, 30, 40K in expenses. So we're going to come down here, we got profit of 60,000. So on that 60,000, you would have been paying self-employment tax of 15.3%. I don't quite know that off the top of my head, so we'll put that in. Got 60,000 times 0.153, so 9,180. So you've got your savings here. It's showing you how much you're saving. This is how much it would have been if you didn't have the LLC taxed as an S corporation. This is how much it is. So you're saving, what, $6,400 or so. That's really important, especially when you're going to compound that over time. So now we're at where we need to worry about federal and state taxes. Of course, at this point, we're going to take into account, are you married? Do you have kids? Are you in school? Do you own your own home? Those types of things are going to become important now. But before that, none of those things mattered. It doesn't matter for the business. Now, there are some areas where they can cross over, like home office deduction or corporate rent expense. But I'll make sure that you kind of know what to do there when we actually do tax planning, or I'll do a separate video on corporate rent and home office. Now, so because at this point it's important to know what happens if you're married. If you're married, you get the standard deduction of $24,000. If you're single, you get $12,000. So let's say this person is single. A lot of you door-to-door guys are still bachelors and girls, bachelorettes, I guess. So we take that $12,000 off. This is cool because everybody gets that. It's not just because you have a S corporation. If you're on a W-2, you also get that standard deduction. But we also have to take into account the QBI, Qualified Business Income Deduction. Really, really important. Donald Trump brought that into the tax plan in 2017. Everybody say thank you, Donald Trump, because this helps save you a lot of money and because he's the best president we've ever had. No, I'm just kidding. I'm not going to get into politics, but I won't even say if I like him or not, but maybe you can tell from my videos. So So what's important? QBI is so important because what it does is gives you a deduction just for being in business. So it doesn't matter. You don't need the S corp to get the QBI. If you don't have an S corp, you also get the QBI. So it's really cool. But QBI, in this instance, it's a federal deduction, not a state deduction. So you got to make sure you don't make that mistake. But it's going to be 20% of your 20% of your profit from your business is going to not be taxed for federal. That is a humongous deal. So in this case, $12,000 as well. So we're going to take off 24,000. So we get to what, 36,000? So $36,000 in taxable income. That's awesome because we were here. If you were on a W-2, you would have been paying taxes based on this number. That's an enormous difference, $10,000 plus. Not only are you lowering the amount that's taxable by a long shot, you're also lowering yourself into a lower bracket. Especially as a single guy, you're going to have a much worse bracket compared to the married filing joint bracket. So in this case, you're going to be looking at about 10% taxes federal. So we're going to go 3,600. And then we're going to go state. It will be around 5% for most states, so it's going to be half that. So 1,800. So we've got your total. 54, 13, 29, 71.54. If that's off, principle's still the same, so give me a break. But yeah, so 7,154. I'm going to say that, and I want you guys to do this tax planning for yourself throughout the year. You know, why wait and do it just with me each year when you could be planning throughout the whole tax year? You can make some important decisions earlier on instead of having it all come in October, November, or December when your time to make these big decisions is short. Not to mention, you probably spent your money maybe not as wisely as you wish you would have if you knew in January, February, March, April, all these early months, if you knew about what you're going to make, you could start making these decisions of what you want to do to lower your taxes. Because at this point, I'm going to say, look, you owe $7,154 total in taxes. So are you happy with that? Most guys are going to say, I'm not that happy with that. You know, I'd like to get it even lower. Most guys want to get it down to nothing if possible. Now, let's say this guy wasn't in school, so he's not getting the school deduction, the American Opportunity Tax Credit, and there's a lot of other things I could have went into that might change this a little, but I want to get to this point where he owes X amount of dollars, and we're going to try and save him some money. So in this case, I'd say, okay, do you have a vehicle? Because a lot of door-to-door guys, they really like the vehicle deductions. They'll say, yeah, I do. I've got a Honda Accord 2012. It's got X amount of miles. It cost $12,000. Say, okay, that's a perfect summer car. Now, do you want to be a recruiter? And this guy's already been recruiting pretty heavily. So he says, yeah, I really want to recruit. Okay, great. Well, one of the best options for you, in my opinion, is going to be to spend some money on an awesome vehicle. Now, normally I would never tell people to go out and spend money and buy a vehicle, but we're talking about getting a triple benefit. I mean, you're getting a brand new vehicle, something really nice. You're going to most likely recruit several more guys because of your vehicle. It's just the way that it works in door-to-door. Guys look up to those that are doing well, that are close to their same age, and they think, I can do what he does. So the vehicle can be huge. You're going to get the tax deduction off of it, and you're going to get the guys. And you're going to have a nice car. So it's triple benefit. In this case, he'd say, well, how much do I need to spend to get my taxes down to zero? And I'm going to tell him, well, we're not going to lower this self-employment tax number too much lower because we don't want to get you an audit. But we could lower that number by another, down to $1,000 if you buy a vehicle that's at least $36,000. We've got to get this number down to zero, right? So let's say he wants to buy a small car. Oh, I really like this Audi. I would tell him, don't get a small car, because on a small car, we can't take the big deductions. We can't take the full value of the car. We can only take $18,500 for year one, $11,200 for year two. Those numbers aren't exact, but they're really close. So in this case, I say you should buy a $36,000 SUV or truck. That's a U or a truck. Because with either of those, we get to take the entire, let's say it costs $36,000 exactly. It's going to lower your taxable income by $36,000. Now you're at zero. So now your federal taxes over here are going to go to zero, state taxes to zero, self-employment tax to $1,000. So now you're looking at a total of $1,000 in taxes due. So think of that, you've already saved so much money just by having the S corporation, just by doing all your expenses to the maximum. But now you're going to save an additional, $6,154. You've got to compound that through time to realize what you've really saved. So go to the Rule of 72 video. Anytime you're doing tax planning, use the Rule of 72 for yourself. To me, it's super fun, and because I like to see, holy cow, I just talked VidArmy down by $1,000 to let me do these videos. I can't believe how much money I just saved, because compounded over time, it's $1 million, So super important to think about that every time you're spending money. If you, save $10 a day on how much you spend on meals, compound that through time and see how much you're actually saving yourself. It makes those trivial small expenses seem a lot more important. Makes it a lot easier for you to actively put yourself in check. For the longest time, I'd go and I'd spend $15-20 a meal no matter what, because it just didn't seem like a big deal to save that $10. Well, if I do that 2 times a day, that's $20. I do that every single day of the month, it's $600, $7,200 a year. Compound that over time and it's millions of dollars. Even at 11%, and I've always done more like 14 or 15% on my investments. Not to mention if you put the money back into your business, like our company will grow 1,200% this year. So imagine getting a 1,200% increase and then who knows, maybe 50% each year for a while after that. It becomes billions of dollars a lot faster than you would think it would. So I can't tell you enough times how important the Rule of 72 is saving money. So please check that video out. So yeah, this guy, he got an awesome tax outcome. He doesn't really need to do a lot more to plan, but that's if he chooses to do the truck or SUV. If he's super smart, then he's going to want to do something that's going to actually help him even more. So my number one thing when I do tax planning is going to be solo 401k. Super important because, like I've talked about in other videos, the solo 401k gets you, is one that you get to set up on your own through a company like Fortress Financial, and with the things that we do and can step you through and show you how we don't invest in mutual funds. We do ETFs only. We don't charge a front end or back load. All the things that these bigger companies do to really hurt you over time, we don't do those. So, you might go into any of these big financial institutions and talk to them and get set up with a solo 401k. Say, oh yeah, our fees are only 1.5%. And you go, okay, that's pretty good. It's about average. Well, little do you know, unless you read the 500-page prospectus, you don't know that they're actually charging you front loads, back loads. They're charging you an annual fee on the mutual funds. They get kickbacks from that. So we don't do those things. Super important to me that we get our clients as much money as possible. If you haven't read the book, Money Master the Game by Tony Robbins, please read that. Make that your homework, whatever. It's one of the books that I basically founded all my companies on the principles taught by Tony Robbins. They're no-brainers, but until you read about them, you really don't know a lot of this stuff, especially if you're, 18 to 25. Guys, read that book. It's super awesome. Another book I recommend is The Goal by Goldratt. It's a little bit different, but it's the other book that I founded my companies based on. So those two books, you get a pretty good idea of what's going on in my mind. It's all about saving the client money. But in this case, this guy, he can put away 20% of his wage, so he can do 10%, so 900. You can do 900. I'll bring it back over here. So he can do 900 plus he can do 19,500. So he can do a total of 20,400 into his solo 401k. And then if he wants, he can also do a IRA. At this point, you'd probably want to mix in some Roth IRA. And a lot of times you'd want to do the whole amount in Roth since your taxes are pretty low already. But I'm a big money now is worth a lot more than money later, especially with how much they're printing new dollars with this COVID-19 stuff. It's a crazy world we're living in. And I just believe that money now is going to really be worth a lot more than once it's inflated to infinity. So a lot of my money is going into things that really help against inflation, like Bitcoin. I'm a big believer in Bitcoin. Don't, stake your life savings on it, but, putting away 5%, 10% of your investing cash into Bitcoin will not hurt you, hopefully. But yeah, so he could do a Roth of $6,000. A Roth does not save you money now. It saves you money at retirement, but it's good to have a mix. This is going to be your traditional 401k, which saves you money now. So by saving you money now, it's going to lower his taxable income by 20,400. So now he's at 15,600 in taxable income. Just lowered his federal taxes down to 1,560. So we'll say federal, 1,560. State is going to be 780. So he saved himself quite a bit, plus we're able to lower this SE tax down to 1,000. So we've got SE of 1,000. A lot of savings there. At that point, he might say, you know what, I'm pretty happy with my tax outcome. I don't need it to go much lower than this. So now I want to do the 6,000 into a Roth IRA. I also want to do an HSA account. HSA it's even above this. It's just an automatic must if you have your own high deductible health insurance plan. You can put in, if you're single, it's, I believe, 4,000. It's about 4,000. It changes every year, so it always throws me off. But it should be close to 4,000. Maybe it's, actually, I think it's 3,500. So you can do 3,500 into the HSA. It's going to lower your taxable income by $3,500, and it's a savings account for health issues. You can use your HSA credit card for $3,500 if, say, you break your arm or your leg and it costs you $3,500 out of pocket. You use that card and now you've used up your HSA in full, but you didn't have to pay any taxes on that income. So why not do it? Everyone's going to have medical expenses, especially you guys that aren't married yet. Think about if you do get married, if you do have 9 kids, especially if you're from Utah, then you're gonna want to have done this, right? The cool thing about it is even if you don't use it, so I personally don't use my HSA and I just let it build over time. because at some point it starts being invested, and it's invested in a way that you cannot lose money. So in no year will you ever lose money on your account, and you'll average between 3 and 5%. So it's really nice because you're adding that like no risk aspect to your retirement planning. So HSA really important. I'll probably do a video on HSAs and on each one of these things more in depth. But just to give you an idea of how the tax planning works, that's an important piece. And then let's say if he did have kids, then why not set up a 529 plan for his kids and put in, $3,000 into that. It's going to get him a state tax deduction, lower his state taxes down a little bit, but it's also going to grow for your children. So like for my son, he's 4 now, Wyatt, coolest kid in the world. He's amazing. But yeah, so if I put $3,000 away for him each year, I'll be able to pay for a Harvard education. If, say, he is smart enough and that's what he wants. Well, I want to be in the position to do that if that's something that he wants. It's really hard to come up with money for a Harvard education if you just start planning on it when they turn 19. So think about that now, put it away every year, and boom, you're going to have everything you need when that time comes. That's tax planning. Other things that you can do, let's say that he still wants to lower his taxes. I can say, well, do you know of anything that you're going to buy this next year for doing door-to-door that you're going to need to buy? Well, I'm going to need, at the beginning of the year, I'm going to need like 10 iPads for all my guys. I told him I'd get him one if I hit this, but I wasn't going to buy him until January. Well, okay, if you want to lower your taxes now, go buy them before the end of the year, maybe December 31st, and we'll take the entire deduction for every iPad. So just plan in a smart way your expenses. You also have to ask yourself the question, well, how much do I plan on making next year? Maybe the number's $200,000 next year. Then I'd say, well, your taxes are super low right now. Be happy with where it's at, and then let's start planning for next year. So any expenses you can push off to next year, let's push them off to next year and save on that much higher tax outcome, right? So yeah, so it's pretty complex. You've got to ask yourself kind of what your goals are. A lot of times, a lot of you door-to-door guys really like to do rental properties. I'm a huge believer in rental properties and do a lot of it myself personally. My partner Mason is big into real estate as well. Some of you guys have probably invested with us through Arrived, or you've done a home flip with us, or whatever it might be. If you are a rental person and you say, well, I want to do rental properties, we're gonna take a completely different approach to this, because you're not getting a rental property if you're showing $15,600 in income. They're just not going to give it to you. So what we're going to do is we're going to take the least amount of expenses possible, except for expenses that are depreciation related. So what we could do is, like the iPads, we could depreciate those over 5 to 7 years. But more importantly, I'd say go buy a new Tesla truck for $70,000. We'll take the entire cost of the Tesla, but we'll still be able to show $100,000 when you're getting the rental property. So super cool. Some people choose to later amend because they forgot their expenses. You can do that 6 months after you close, but that's only if you forgot your expenses. You can't just do it because you planned it out that way. If I know that you planned it out that way, obviously I can't let you do it. But if you forgot, then we could go ahead and do it. So yeah, I think that's a pretty good start on tax planning. I'll go in depth more on some of the other things, do a different video on rental properties and whatnot. But hopefully that's helpful for you.